What is dividend? It's one of the main questions I get when I talk about stocks, and particularly dividend stocks. People love dividends for a reason, and one of the most popular investors of all time, Warren Buffett, is world famous for his dividend income. So after you watch this video, you know everything about dividends, the most important things to look for, different type of dividends, and some tips to help you to get the best dividend stocks out there. And I'm also very excited to see what you guys think about dividends, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what is a dividend? A dividend is the distribution of a company's earnings to its shareholders and is determined by the company boards of directors. Dividends are often distributed quarterly and may be paid out of cash or in the form of a reinvestment in the additional stock. So to put it simple, you have a stock of a certain company. Let's use Coca-Cola in this example. Coca-Cola decides to pay their shareholders a dividend of $0.46 for every publicly traded share. Since you own 1 share, you get $0.46. If you own 10 shares, you get $4.6 and so on. So the next question is, why would a company pay dividend? Well, that's quite simple. It allows the company to share their profits with the shareholders, which help to thank the shareholders for their ongoing support for higher returns and to incentivize them to continue holding the stock. In the end, this could lead to higher share prices. When a company did pay dividends in previous quarters but decided to stop the dividends, it's called a dividend cut. A dividend cut occurs when a dividend paying company either completely stops paying out dividends, usually a worst case scenario, or reduces the amount it pays out. So how often do dividends get paid out? In most cases, stock dividends are paid 4 times per year on a quarterly basis. There are of course exceptions, as each company boards of directors determines when and if the company will pay a dividend. But the vast majority of companies that pay a dividend do so quarterly. There are companies that pay a monthly dividend, and in some other parts of the world it's more common to pay only every 6 months a dividend. On top of that, there are also special dividends. A special dividend is a non-recurring distribution of company assets, usually in the form of cash to shareholders. A special dividend is usually larger compared to normal dividends, paid out by the company and is often tied to a specific event, like an asset sale, corporate restructuring, spin-off or other windfall generating event. Special dividends are also referred to as extra dividends. Important dividend dates. When a company pays dividend, there are 4 dates that are very important. We have the declare date, ex-dividend date, record date and payout date. The first one, declare or declaration date, is the date on which the board of directors announces and approves the payment of a dividend. The ex-dividend date is the first day that a stock trades without the dividend. The company does not set the ex-dividend date. The ex-dividend date is set by the stock exchange where the company's stock is traded. The ex-dividend date typically occurs up to 3 days before the record date. Purchasers of shares on or after the ex-dividend date are not entitled to a dividend. The record date, also known as the date of record, is the date on which the investor must be on the company books in order to receive a dividend. The record date is commonly confused with the ex-dividend date. Recall that the record date is set by the company and the ex-dividend date is set by the stock exchange. The ex-dividend date is earlier than the record date due to the fact that there is a settlement period for the stock trades on exchanges. The payment date is the date on which the dividend is paid to the shareholders. Dividend payments may be either mailed or electronically transferred to the accounts of the shareholders. Next to these dates, there are also some important metrics when it comes to dividend. The first metric is the dividend yield. This is one of the first things most people look up when it comes to dividends. It's basically showing how much a company pays out in dividends each year relative to its stock price. So if we take the example of Coca-Cola again, we see that the stock price is at $58.91 and the annual payout is at $1.84. If we divide 1.84 by 85.91, we get a dividend yield of 3.09%. We automatically covered the next metric, which is the annual payout. The name says it all, so I don't think an explanation is needed. The next metric is the payout ratio, one of the most important metrics when it comes to dividends. The dividend payout ratio is the ratio of the total amount of dividends paid out to the shareholders relative to the net income of the company. It is the percentage of earnings paid to shareholders via dividends. When the payout ratio is higher than the earnings, it will be above 100%. This means the dividends are not safe since the company can't pay its own dividend and is likely to either cut their dividends or to issue debt to pay the dividends, which are both things that we want to stay away from. Most people like to see the payout ratio below 50%. This is considered a healthy ratio, since the other 15% can be invested in the company itself by improving the business, do acquisitions and all other things. The next metric is the 5-year growth rate, which is also an important metric when it comes to dividends. It tells the investor at which rate they are increasing the dividends in the past 5 years. Most investors want the dividends increasing over time, so the passive income will increase as well. Depending on the sector, the stage the company is in, the current dividend yield, and the expected future, the 5-year growth rate can be very different per company. Most tech companies or high-growing companies that pay a low dividend yield have higher growth numbers in general. And most companies that are slow growing in revenue and already have a decent dividend yield have lower numbers in the 5-year growth rate. The last metric is the consecutive years of dividend increases. This tells the investor the amount of consecutive years the company has increased the dividends. This also tells the investor that a company has a certain track record when it comes to dividends. However, this doesn't have to mean anything for the future, of course. Of course, there are classifications for this one. Dividend Aristocrats are companies that have increased the dividend each year for the last 25 years, are members of the S&P 500 and have a market cap of at least 3 billion. Dividend Champions have a 25-year streak of dividend growth. The question is how this list compares when placed against the standard S&P 500. Dividend Kings is a more exclusive list. To belong, a company must have extended their consecutive streak to at least 50 years. Only a few companies are in this list. To have a steady and consistent dividend paying stock, there are 2 other important metrics to keep your eye on: free cash flow and shares outstanding. The free cash flow is used to pay out the dividends, except for REITs, they use funds from operations, which we will cover in a different video. So in order to increase the dividends, it's needed that the free cash flow is growing alongside with it. On the other hand, you want the company to have a decreasing shares outstanding, since this makes it easier to pay the dividends, since there are less shares outstanding that receive a dividend. In the end, this could lead to lower payout ratio and higher dividend growth, which is something that we all like, of course. There are also different types of dividend paying companies. We have low yielders, high yielders, dividend growth stocks and dividend traps. Probably there are even more names to classify a dividend company, but these are the main ones. Low yielders and high yielders kinda gives it away already. These are companies that either pays a really high dividend yield or a really low dividend yield, such as these 2 companies in this example. Nvidia is considered a low yielder, while T. Rowe is considered a high yielder. But high yielders come with a risk. A high dividend yield means in most cases a higher payout ratio, which could lead to problems in the future for the company. This could be a worst case scenario, of course, where the company goes down the path of no return other than to cut the dividends. Companies with certain risk indicators are called dividend traps. These are companies where it's expected that there might occur problems in the near or long-term future with the dividends. The last one is something that I really like: dividend growth stocks. These are companies that increase the dividends at high rates, such as T. Rowe in this example. Dividend growth rate is at 16%, or Broadcom, where the dividend growth rate is at 28.5%. Whenever you receive a dividend, it's all up to you whatever you are going to do with it. You can cash out and pay your monthly bills, of course, or you could save up some cash and buy new stocks with the received dividend. This is called reinvesting your dividends and is something a lot of people like. By reinvesting your dividends, you will get more dividends the next time and so on. This could lead to massive returns over a longer period of time, of course. In this graph we see that reinvesting your dividends might be a good thing. In this example we see the returns of AbbVie and the overall market, in this case the S&P 500. On the 5-year chart we see that AbbVie had a 35% return in stock price without dividends. The S&P 500, the benchmark in this case, had a return of 44%, meaning you were better off owning the S&P 500 than AbbVie if you didn't reinvest your dividends. But when you did reinvest your dividends in those 5 years, you were having a 70% return with AbbVie versus 58% return with the S&P 500. So AbbVie beaten the S&P 500 including dividends. And now that you know everything about dividends, it's time to show you the last part of the video, which is about some popular dividend stocks. This isn't any advice to buy these stocks, it's just a list of some popular dividend paying companies. First in line is Realty Income, also called the monthly dividend paying company. As the name already gives it away, they pay a juicy monthly dividend of 4.8% and they have grown the dividends for 28 years in a row, which is quite impressive. Since this is a REIT, the payout ratio isn't correctly displayed here, but this is something I will explain in a different video. Next on this list is Home Depot, known for having a steady and consistent dividend track record at a high growth rate. Dividend yield is around 2.8% and the dividend growth rate is at a whopping 16%, which is very impressive. Last stock on this list is Starbucks. A lot of people own Starbucks stocks because of emotion, but they also pay a decent dividend of 2% at a growth rate of 13%. Annual payout is at $2.12, so owning a few shares of this company could pay your daily coffee. This was the full list on what is a dividend. Expect more of these kind of videos in the future. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some new insights to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.